actually about what actually is happening. And we're looking at the end of the fiat dollar. I think this is really what it's all about. The central bank community, particularly in the global south, BRICS and so on and so forth, they can see what China is doing. With the SGE opening vaults in Hong Kong and also Saudi Arabia, and there are probably plans for other ones, or certainly facilities elsewhere, whereby gold can be exchanged for yuan. This is setting up a system which will allow the Chinese, if it is necessary, to protect the yuan's value by turning it into a gold substitute.
In today's news headlines, London Bullion chief seeks gold futures revival. The new chair of the London Bullion Market Association has urged the revival of gold futures trading in the UK, despite earlier failed attempts to establish derivatives contracts in the world's largest physical gold trading center. Peter Zoellner, whose organization represents bullion trading banks, told the Financial Times on Wednesday that previous efforts to launch gold futures in London had been premature, but added the global market would benefit from having 2 or 3 places with decent liquidity. I think it makes sense that the gold market can trade on different venues, Zoellner told the newspaper. Sometimes people start something a bit too early. Maybe we are in a different situation. His comments come as uncertainty surrounding President Trump's tariff policies has raised concerns about trading on U.S. exchanges. London Metal Exchange volumes for base metals have risen this year, whilst New York's have declined, said the Financial Times. London's bullion trade predominantly occurs through bilateral over-the-counter physical transactions with no futures market. CME Group's COMEX operates the most liquid gold futures contract in New York, followed by Shanghai Gold Exchange. The LBMA is also considering releasing more pricing data publicly, including forward contracts and real-time prices. Zoellner, formerly head of banking at the Bank for International Settlements, said developing a strong benchmark for a forward price would enhance market transparency. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
I've heard numbers of sort of 2 billion, 3 billion ounces. I don't know. I don't think it's nearly as much as that. I think all you can do is look at the stocks in COMEX and look at the stocks in London, and perhaps pencil in a figure for something in Switzerland. The rest of it, I think, we'd rather ignore, because the idea that you've got these investors, if you like, in places like China and all the rest of it, are likely to sell their stuff. I mean, if they sell it, it would probably, circulate within the country rather than come onto the general market. I think that these people are increasingly concerned that if they do sell their silver, they're not going to get it back. And the reason I think that they are feeling that is that if you have hoarded silver, or indeed gold, and to a lesser extent platinum group metals, you are obviously taking a view that the purchasing power of the dollar or your own currency is declining. I think the answer is you hang on to your silver. I think that's what people will do. And I think that's what has really resulted in the squeeze in the market. I mean, if you look at the stocks, in the vaults in the LBMA, I can't remember exactly what the figures are, but people try and make a guess about liquidity, and it's pretty minor. It really is. And of course, not only have you got the whole world, the retail world, I mean, all around the world, the story you were telling, a global story, if you like. And under those circumstances, you sort of think, well, if I am going to sell my silver, do I sell it while there is a shortage? I think I'd probably ride it out a bit more. That is if you're even trading it. If, on the other hand, you're a hoarder and you're sort of looking at what's going on in the world and all the rest of it, then you probably think, well, wasn't I clever buying it? I'm just going to sit on it. the thing about Bretton Woods is that it was this sort of high level, you can't exchange your currency for gold. But this is a system which basically everybody who's in Bretton Woods, we're in there at a fixed rate, and gold basically is the tie for all the fixed rates. And that was fine so long as the Americans, who had the bulk of the gold, certainly in the late 1940s, that was fine until the Americans began to run out of gold. And then, you had the end of Bretton Woods.
In today's news recap, gold extends losses near $4,100 as traders brace for renewed volatility. Gold continued to retreat on Wednesday, extending losses after its sharpest single-day sell-off in more than a decade. The metal traded around $4,100 an ounce, slipping further after Tuesday's 6% collapse, while silver steadied near $48.55, unchanged from its opening level. The correction has paused a 2-month rally that pushed gold and silver to historic peaks, driven by fears of currency debasement and expectations of major Federal Reserve rate cuts, with volatility surging and investors' repos. There's been only 2 market commentators so far highlighting that this could happen, Celente and Lobo Tigre, while the rest of so-called analysts, brokers, and dealers were hyping it up for higher prices. The truth is, gold's meteoric rise has cooled sharply, with the metal now consolidating near $4,100 following a dramatic sell-off that erased more than $250 in value since Monday. Tuesday's 6.3% plunge, the steepest intraday drop in over 12 years, marked the end of a rapid advance fueled by safe haven flows, central bank accumulation, and the so-called debasement trade. While spot prices have steadied slightly from Tuesday's lows, volatility remains elevated. 1-month implied volatility for gold options hovers near the highest level since early 2022, signaling that traders are bracing for further turbulence. Many funds are now re-hedging positions after the sell-off, using options to guard against a break below the key $4,000 support. The surge in derivatives activity follows months of record ETF inflows and aggressive physical demand from central banks dynamics that amplified both the rally and the correction. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
In other words, it's a complete reverse, if you like, of market theory that rising prices will, release more product. Now, having said that, I mean, you've also got other factors coming in. I mean, there is no doubt that the mines are becoming very profitable on these prices. You must be coining it in. And, if it goes up further, even more so. But what does a mine manager do? And I think this is a point which many of the sort of commentators don't really understand. A mine manager's job, basically, is to maximize his cash flow in the context of the business he's running. So when he sees the price rise, what he does is he mines the lower grades. So does this lead to more supply? Not really. And the other thing is that I think over 50% of silver mine supply comes out as a byproduct of the mining of other metals. So, that's something. Scrap takes a bit of time to, it doesn't take terribly long to turn it, but it's a question of refining capacity. And at the moment, refiners, they're not really interested in taking in silver because they're so busy with gold. So, there are a number of factors which I think lead to the squeeze. And, anybody who owns silver, I think, when they reflect upon it, they sort of think, well, wasn't I right to buy it? And I think that's the way it is. And with gold, there's something interesting there too, because we don't have the backwardations between the spot and the futures market. Seems to be quite normal. I think that the bullion banks are trading that reasonably successfully. I think they probably welcome the uptick in business. They will be losing a bit on their positions on a mark-to-market basis, but they will be making lots and lots of money dealing, I think. But the problem I think the gold market has is that following the fiasco earlier this year, whereby the Bank of England was exporting gold out of its vault as quickly as it could, I think the central bank customers, because it's mainly central bank gold going out on lease, I think they would probably question the wisdom of leasing, because in the past it was leased and it would sit in the Bank of England's vault. Okay, it goes round and round and round, being hypothecated, rehypothecated, rehypothecated, and all the rest of it. But at least it was in the vault, and you knew it wasn't going to go anywhere by the end of the lease. Now it's gone. It's gone. So where's it gone? Am I going to get my gold back?
What do you think of today's show? Do you believe that the current gold and silver sell-off is some sort of coordinated attack against the metals, as Alasdair says, or on the contrary, is just big players taking profits after an abnormal rally? Post in the comments section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, peep this video right here because it's a perfect fit